Bonsoir. I'm just waiting for others to join. I'll wait till about 15 join. I wonder if you can hear noise in the background. I apologize if it's distracting. My husband is having his piano tuned by a professional, and this is the time the guy could come. So hopefully they'll be done soon. This is the document I want to start with. It looks familiar. It's document 25. Okay, well, it's 10 minutes after. We have 10 students. I have one student wrote me about the nominal, the relationship between nominal and real cash flows. When I taught that, I taught you 3 different formula, remember? And you can get it from these notes here. At the beginning, you see, you need to use this formula. This converts real to nominal cash flows. Okay, so that's how you would do that. So I don't know if Diego is there, but that's how you would do it. Elsie. Elise? Diego Elise. Anyway, you guys can let him know. Okay. Maybe I can take a screenshot and send it to him. So where I wanted to start now is I want to pick up where we left off. Sending a screenshot. All right. Can you hear me all right? Is the noise distracting? Oh, more people in. More people have arrived. Okay, so I want to pick up where we left off. it was a discussion of calculating ultimately we wanted to know about the correlation between these data sets. One represents the returns to company stock, and the other represents returns to the composite index representing the market, the stock market, or the economy, really. That's what we want it to reflect, okay? So when the economy does well, the stock market does well. And that's what picks it up. So what we discussed then last class is reminding you about the correlation computation and these formula. I taught you how to get these numbers out of your calculator. So this is the mean, the standard deviation, for what we refer to as historical data. Historical data, each data point is equally important. And from statistics, we discussed that this is the mean, this is the standard deviation, and this is the covariance. And I explained to you the covariance looks like the variance, but I'm covarying. You can look back at the video we did in January regarding the covariance. And what the correlation actually is the standardized covariance. And it converts covariance, which could be any number depending on the type of variable you have, to a range of values on -1 to 1. And then we can interpret if it's perfect correlation or something in between. And I showed these other formulas to you, but really this is what you need to remember, okay? That the relationship between covariance and correlation. So this converts to R, which is a measure of direction and strength of a linear relationship. That's what R is. Okay? So R reveals the strength like covariance cannot. So that's why we use it. Strength means how close a fit to a line the relationship is. So the closer to -1 or 1, the better the prediction line. So then this is for historical data, but then I left you with ex-ante data. And so this was the example with ex-ante data. And all I've done here is presented the table with probabilities, right? So this says this is now a distribution. This is a discrete distribution of returns. And there's only 3 possibilities. And these are their likelihood. So the possibility of a boom, so this is when the economy does well, expansionary phase of the economy, then it looks like S&P will return 14% and BCE 30%. It's not exactly double, but then again, this is not the same sort of thing as above. In a nominal state of the world, so things didn't change too much, not a boom and not a recession. These are the returns, so they go down, right? Because it's not like a boom when things returns are higher. And in a recession, this should be the worst, right? Where you're in a recession, the economy is bad. The chance of that happening here in this world is 10%. So these are the calculations that you'd have to make when data are ex-ante. Again, it's when you have this column of probabilities or likelihood of certain outcomes. So this is called the weighted mean, the weighted standard deviation, and I use this notation. I forgot the X here. I need to fix this handout. And this is the covariance. Notice the symbol sigma xy. Sigma xy. So this is the covariance here. That looks very much like this, but I'm using the deviations from the mean of in the x direction or horizontal direction, and the deviations from the mean in the vertical direction. And this is capturing the covariance. Now, the covariance standardized gives you the correlation, and these are just other ways of writing it, but this is the most important here. And finally, the beta, the slope. The slope is, remember from above, the slope is calculated as RSY over SX that I taught you. And so it's the same here. In terms of the Greek letters, I use the Greek letters. Remember, I use Greek letters when I have a distribution. This represents the population. So with the Greek letters, this becomes B in Greek is beta. R in Greek is the symbol rho. It looks like a P, but in Greek it's an R. And then SY over SX. The standard deviations in Greek letters, I'm going to rewrite those as sigma for population, and it would be sigma y over sigma x. So this is really important so that you can follow me, because what I'm going to do next is speak particularly in terms of the variables that were used, not these general formula. So this is R SY over SX. R SY over SX equals the slope. So you can practice making these calculations. I gave you all the solutions to verify your work. You can do this in Excel like we did yesterday. We started working on this sort of thing yesterday. I calculate the standard deviation. For the weighted standard deviation, I calculated this one. So you guys can practice doing these ones. And you can get the results in Pages, documents. I think 26 and a half and 25. Let's see what I did here. Like these solutions here, these are the solutions for solving this situation, okay? So this is a 25.2. So you can practice making these calculations in Excel to see if you can get them. And you find out that the correlation coefficient actually is 1. So correlation is 1 as well for this data set as the other. So it means perfect positive correlation. And it turns out also, you can't see it. You don't see it so much because of these weights. It hides that from vision. But if you make the calculations, you'll find beta is also 2 here. It looks kind of close. It looks kind of like double. But if you check, so I'm going to leave that to you for practice. So verify all these calculations. So what we're going to do next, so that was statistics. That's what we learned in statistics. Now as a tool, These are the same data sets, but what I've done here is converted the formulas using notation that we're going to use in finance. If you look back at the other page, this is the same sample mean or average mean, average or mean, but I just use R and I've used a big T here. And here I've used R instead of X, right? And use T instead of N, and so on. So you can follow the symbols. I hope this doesn't intimidate you. It's just to convey to you that we're using the same formulas, just different notation in finance. In particular, X becomes R, returns, because those are my variables. And look, I name these RI, and these ones are M for market. This is I for asset. That's for the X post, where everyone has the equal, provides equal information. Every observation provides equal information. But in the case of ex ante, these are the formula and the notations. Okay, so here you have the same sort of thing, but I'm using R. Okay, so you should print these documents. You should print the documents with the formulas and convince yourself verify that you follow this. Okay, verify that you follow the notation that I'm using. So you're going to compare then documents 25.1, all the documents that I gave. Let's see if I have 25.1, just 25. Do I have a 25.1? Yes, I do. Okay, so what I'm going to say to you, so look at the documents. Oops. 25, 25.1, 25.2, and 25.3, and you'll see they're all related. Okay. Okay, so what are we going to do next? I'm going to now discuss the subject. Let's see. So that was my statistics review. So go back. You have to sit with the materials, go back, and and practice making these calculations, okay? What you have here are some questions. This is document 26. Okay, this is where we're going to start. This is document 23. All the other documents are for review, right? Do you hear me now? Yeah, that's my husband's piano is being tuned, and it's next door. It's very loud. So let's just start on these notes. Hopefully they'll be done soon. It's terrible. I'm sorry. All right, so, oh my goodness, there's no resolution. I could go in the bathroom. I don't know if that's going to help. All right. It's just that my husband's been trying to get this guy here for a year. And this is what happens. Hold on, let me see when he'll be done. I'm going to check. Okay, is that better? A little quieter? Okay, so we're going to start here. What we're going to do now is talk about where those numbers come from. Where do these numbers, or all right, so just keep in mind what we're doing. So remember these numbers that we were dealing with. We want to calculate one at a time. So let's figure out where this comes from. If this is the return for a particular stock, make it smaller. All right, so what is this made of? If you think about stock and being a stockholder, your return will be in period, at any point in time. Your return to holding the stock will be the dollar dividend. So the dividend, remember, a stockholder may be given a portion of the profits of the firm, and that's called a dividend. So for each share, they get a fair share of the profits, or the fair share that's considered for stockholders. Because some profits go to bondholders first, right? So if people have loaned money to a firm and there's a commitment for the firm to pay them coupon payments on their debt or interest payments, then if there's still something left, the firm executives will consider issuing a dividend. So the dollar dividend is something you can receive, but you also, as a shareholder, experience an increase in value if the stock price goes up. So that's what this is. This is the change in market value. So this is just the change. I'm going to get rid of this now that you know, right, what that is? This is the change in market value from today minus the price last period. So this is the price today minus the price last period. Now I haven't said years because it doesn't have to be years. A schedule can be of returns can be in days, it could be in hours, it could be in months, it could be in quarters, it could be in years. So it could be at any time scale. But that's why I just use T. So that's what a dollar return is. But what we like is the percentage, right? The data that I showed you demonstrated the percentage return. Right? This shows the percentage. So how do I get the percentage? Well, I have to take the dollar return and divide by the original market value. And this gives us something interesting. So this is me doing that. Here I'm going to take the dollar return and divide by the initial market value of the stock. And then if you could write that this way mathematically, or you can write it like this. This separates if you distribute the denominator. This separates into what's called the dividend yield and the capital gains yield. Now these portions of the return are taxable. So as an investor, you would have to pay taxes on capital gains yield if you were to sell the stock, so you need to record that information, and you would have to pay any taxes on dividends, and those rates may be different. Okay, so capital gains are only realized if you sell the stock. However, it does give it economic value. So we can either talk about the dollar return or the percentage return, and the convention is to work with percentages. So this is how that table of values that's where these numbers come from. Okay? And I'm specifically referring to the stock because this is a little more complicated because it involves 500 companies and creating an index of all the stocks, like in a weighting to make a portfolio representing the market. So that is a little more complicated. So I will just say this method could be used to calculate these returns over time. All I've done here is 1. But that's a general formula. Okay, questions? Do you have questions for me? Okay, so let's continue. So there's some things to point out here to you, that you've actually been using this formula with certain assumptions for some time. It might not look familiar, but you've been using it. For one thing, this is a rate of change. In general, to calculate a rate of change, so percentage change, you take the new value minus the old value divided by the old value. You can say new or no to remember. That's how you calculate a percentage change. And it turns out that this is a good estimate of growth. It's a way of calculating the growth rate. Growth rate of returns is important, right? To compute the towards computing stock value overall, the price. So let's see. So that's what this is. See, new. That's now. That's last period over last period. So that's new minus old over old. I'm saying this in a general way. So this is today, and this is yesterday divided by yesterday. I haven't specified what time period, but that's the idea. So what else? Remember this formula. What is this formula here? This is the formula of perpetuity with growth. And we use it to value stock when we have information that a company is issuing a dividend, and then the dividends will subsequently grow at a constant rate. So there are assumptions. Remember, we had assumptions here that the first dividend is in one period from today. I'll just say from 0. That the dividends grow at a constant rate and they grow forever. And they grow forever. So you remember this formula, correct? Well, I could write this formula. I could isolate or analytically solve I, and you would get I minus G equals C1 over PV0. So I equals C1 over PV0 plus G. So if I have these assumptions in place, if these assumptions were in place, then the return would be constant. And it would be this number. So how does this go back to what we have here? How does this relate back to here? Well, this is the dividend. This is the dividend in that year, so this would be like our C1. This is the price last year, and also that is. But let me not write that right now. Let me just say this is the price last period, and then this represents G. And that's if the assumptions of the perpetuity hold. So what I'm saying is, really, we've been using a variation of this formula all along. I derived it in a different way, but we can generalize this formula saying that this is not necessarily constant over time, that it can vary from year to year, and so can the dividend as a result, and we can calculate the returns for each year. So my point is that if we have these assumptions, we can use them to estimate the discount rate. This is a method known as the dividend growth model. And it's a way to calculate returns when you have certain assumptions and you have certain information. Now, if you don't have these assumptions, you have to use this general form. So I'm going to say this is specific. And the other one is general. So don't let these subscripts bother you. It's just when you read them, you have to say either today or time now, and this is last period. This is today, and this is last period, okay? So this is the general formula. This is specific and I for all periods. And this is general formula, for R, the return in each period T. So it can change. So if I ask you to use the dividend growth model, you have to use this one. If I ask you to find returns, you use this formula. Or if I ask you for a different variable, you use this formula. All right, with that information, let's take the formula with us to make some calculations. Remember, our goal is to find estimates of returns. In this case, the return is assumed to be the same thing. It's assumed to be the same always. So let's take this formula with us. Oops, what happened here? Oh my. I'm not sure if my thing's gonna crash. I'm not sure what's happening. All right, so use the formula now to answer these questions. How's it going? Okay, A. Right, so what, you could do them separately. This would be dividend yield, and this would be capital gains yield. So let's name everything. Initial price would be PT minus 1 for the formula, and this would be the dividend today, and this would be the price today. So that's how you know what's going on. So let's do the dividend yield first. The dividend yield is going to be 84 cents divided by the initial price, which is $42. And it gives you a percentage return of 2%. Okay, do the other one. Let me know. What do you get for part C? Okay, very good. So the next, for capital gains yield, you need to take the new price, which is 46.20, minus the old price, which is $42, and divide by the old price. And you find you get 10%. So then this must be, the total return is a sum of those two, it's 12%. Okay, you ready for the next page? All right, Now, this is all going to look very familiar. Okay, so I hope not to confuse you, that I keep relating things back to what you learned, but I want you to feel like you didn't learn a lot of things, you just got deeper into the things you already knew, okay? So what's this? This is regarding if you have, again, let's put that chart up. So here, let's say you wanted to figure out, given this data, let's make it like this. So given this data, you wanted to figure out what, over this period, if they're sequential, then what was the, if someone invested here, for every dollar they invested, they get 30% in the first year, 18 in the second, 20 in the third, 15 in the fourth, and 16 in the fifth. So if they kept the stock, what would be their return over the entire period? Notice the numbers are different. You would have to multiply 1 plus, right, like as a factor, accumulation factor for each return, and then minus 1 from the principal, right? You just want the percentage return. You don't want the principal of $1 invested. So this is how you would calculate what's called the holding period return, and it reveals how much you made over the set of, or over that time period. A set of periods together. And what's this? Well, over that time period, the highest was 30% and the lowest was 15%. But let's say I want to know what I got on average each year. Well, you can get the holding period return and then divide by T. Is that the correct way? Well, no. We learned that that occurs in the exponent. So we did, this looks like, this should remind you of effective period rate calculations. Right? When you have to multiply them together and take a root. But here I have different ones. That's why we have like they're all different numbers, like here, different, not the same. Okay, so this is called the geometric average return. It's an average, but it's called geometric average to distinguish it from the arithmetic average, just adding them and divide. This is a simple average, or the regular average for the sample mean. So the rule is, if you calculate the geometric average return and the arithmetic average return, and they are the same, it doesn't really matter which one you use. What should you do if they're different? What do you suggest? Very good. So yes, you would use the geometric average return because we learned that the arithmetic mean is sensitive to outliers. So if the distribution of returns is skewed, this won't be a good measure. So if these two are different, you should use this one. This one is more stable, and also it reflects the effect, the compounding effect of the returns. I'm going to give you an example now to show you that that's exactly the case. Are you ready? Here are the returns over the very unstable period of 2007 to 2010, when the market, the US market, and worldwide markets crashed. So there was a stock market crash in 2008, and look at here. These are the returns to the S&P 500. Horrible, right? The question I'm going to ask is, how much did an investor starting in 2007 make on every dollar invested over this period? So what's the holding period return over this period? Next, I'm going to ask you, what's the average return over the period? And I want you to calculate as geometric and as arithmetic. So you should practice that. I'm just going to show you the results, but you should practice, okay? Try making these computations. Actually, it's going to be on the next page. I actually got the data from this website if you want to see it. So you could put this data in your calculator or in Excel, and be careful with this negative here. And the holding period return would be negative 3.3%. The geometric average return is a negative, but the arithmetic average return is a positive. What you can do, let's do this together actually. Let me take this into Excel, just so that you feel a little more confident about doing this. I'm going to take this, I don't know if I can carry it to Excel, but let's see if I can do it. I'd have to take a picture, oops, and go to Excel. So if I do this in Excel, I could say here is a year. And here is the return. So this would be 2007, this is 2008, 2009, and 2010. And then the returns are, I'm going to write them as decimals, 0.0549, negative 27, 37, and 2646. And 0.1506. And what you want to do is you want to multiply. So for the holding period return, you want to get 1 minus this amount, and you want to copy that all the way down. And then sum it. No, you don't want to sum them, you want to multiply them, right? You want to multiply those You can probably do geometric average return in this in Excel. I didn't even think. But then what you want to do is minus 1. Don't forget to minus 1 because, oh, I got it wrong. So let's see what I did wrong. The number's right, 0.0549, 0.37, 0.2646, and 0.1506. And then I took 1 minus, 1 minus, 1 minus, 1 minus, 1 minus, and then I multiplied them. I don't know. Now I want to check it. Should be right, no? Everybody watching me? Did I make a mistake? Let's see if I can do geometric average return in Excel. I think Excel froze. Okay. Let's see if I can do equals geometric average return. No. Metric mean. Okay, that would be it. And then I want to get the numbers from I don't know why I can't do this. It's not touching. Okay, so geometric mean would be I6 to I9. Didn't work. It wants me to put them one by one. I6, I7, oh well, I'm not sure why it's not working. So yeah, the Excel on my iPad is different than on my computer, so I'm a little bit confused why I can't do certain things. All right, so what did I do wrong? Minus. Any ideas? It's possible there's a mistake there, but I think I checked that a million times. Anyway, try and confirm it. Oh, that's why, because it's 1 plus. That's why I did it wrong. Oh my gosh. I don't know why I'm using 1 minus. All right, it should be 1 plus, of course. I'm having trouble with this thing. I don't know why. Maybe saving it will give it some boost. Let's see if that helps. Okay, let's do this properly now. It's not 1 minus, it's 1 plus, of course. Right, because it's a factor. 1 plus, I don't know what I was thinking of. So I'm going to copy and paste and paste and paste, and there you go. That's the answer. So you can use Excel to make this calculation. Now if you want to get this, I should actually say this is the holding period return. And if you want to get the geometric average return or geometric mean, then this is just the square root of this one. And it didn't work because why? Oh, because it's a negative. Oh, what am I thinking? How would I get that? Let's go back and see what I did. I have to add 1 first, right? I have to do factors, don't forget the factors, right? So 1 plus holding period return will get me the answer. So I have to make the calculation of GAR using 1 plus factor, and then I have to raise it to the power of 1 over 4, or 0.25, and then minus 1. You still with me? So those are those answers, and then the average is just simple, it's just adding them up. If I want the arithmetic mean, the regular mean, it's the average. You can use average of these. And what did I miss? Why is it? Oh, I did the wrong. I keep making mistakes. I don't want to average those. I want to average the original values. So I want to average these returns. Well, you're watching me in action. Sorry. I'm trying to help you, but I didn't practice this. I didn't practice using this. So there you go. That's faster, as long as you don't make any mistakes. There's a faster way to make the calculations. Any questions? So as a percentage, this would be negative 3.3%. And as a percentage, And as a percentage, this one would be negative 0.8%. Okay, so those are the as percentages. Now, which ones are more if this is the over the period investing, you get a negative. So if you invest $1 in 2007 and you left your money there, over this period you would have lost 3 cents on the dollar. And then this one is each year. So here in the for the GAR, it says each year lost 0.8 cents on average for each year. And then, so which one is better, right? It's clear that the GAR better reflects what's happening than the mean. It looks like it's a positive on average every year. That's not right. Okay. So let me see if I made a mistake. Yeah, 8.4. It was negative 0.84%. It's a loss. I can write it as 8.4 so it looks like the notes. Okay. Questions? Okay, no questions? It's good? So you can replicate these calculations. And that's how I did it. So sorry for the errors as I was going. It's really hard. I don't use my iPad for Excel, so I'm used to using it in a certain way, and it's different on the iPad. Okay, so that's that. Any questions? So the conclusion here is that's the best measure of average annual return over the period, the GAR. Overall, over all 4 years is a loss of negative 3.3%, which is on average up almost about 1, right? 0.84. That makes much more sense than this. This would be very misleading. This is a positive return when, on average, when this is demonstrating it's not the case. Okay. Any questions? Okay, let's take a 5-minute break and then we'll get through the next bit of notes. The piano guy is almost gone. All right, I'm back. Let's see if you have any questions. In the real world, if you want to know the return over time, you use the holding period return. In general, in life, in corporation, in business, and if you want to know how much you made on an investment, you use a holding period return. If you want to report how much your investors made, use a holding period return. If you have to respond to investors, it's a very important number to reflect. So we've talked some about the measures of return. I talked about holding period return, which gives you the return over a long period of time. And we talked about an average return that gives you the return over, on an average basis over time. If you're doing this by year, then you would give the average annual return. What about the other measure when we know there's some variation in the data? So again, let's just insert that table. So remembering this table, I'll put it here. So there's variation, right? Over time. It's not a matter of only looking at the average. How volatile are these returns? It goes as low as negative 37% to as high as 26%. So it recovered, but not completely over this volatile period. Remember, because the holding period return was a negative, so it didn't recover the loss. That's very important to be able to say. So let's talk about volatility. Here are three classes of assets. You have the measure of the market returns as the S&P 500, and those are the more wild returns that I've plotted here between 1928 and 2000 and supposed to be 16. And then not so wild in between with the dashed line are the 10-year Treasury bond returns. And then the most solid, regular one here is the 3-month Treasury bill. So in the US, there are Treasury bonds that are considered relatively low risk, okay? Relatively low risk, as opposed to investing in the stock market as represented in the S&P 500 index, which is quite variable, okay? So it turns out we're going to look at these, in particular, the Treasury bills versus the common stock. Common stock is considered most risky because it has the most variable or most volatile returns among the three. T-bills are less risky in their returns, and 3-month Treasury bills are the least. So 3-month Treasury bills are discount bonds. You buy it in January, and by March, end of March, you get the face value of the bond. The bond matures. And those issues set a rate in the market, because all other returns, all other assets are compared to this low risk rate. It's low risk because if the government doesn't have the capability of paying investors, government can also always increase taxes and collect tax revenues to pay the creditors or bondholders. So this is why it's considered guaranteed, as opposed to investing in common stock that has no guarantee. So these are the returns over the period 1928 to 2016 for the United States. Let's calculate, let's first work with the data that we have, the 4 years, to calculate the standard deviation of those returns. And then I'm going to talk more about this data set, okay? So here you see, this is the calculation of the standard deviation. We have to take the deviations from the mean, square them, and average them. Then take the square root to get the standard deviation, because what you have here is just the variance. So here's that calculation, which you also could conduct in Excel, so I'll do that right now. So let's go back to Excel and calculate the variance. So how volatile were these returns? So I'm going to take this data from here, and let's calculate the variance down here. I think you can just get the variance. You can get the standard deviation in Excel. And that's it here. So it's 27%. 27.69. So if you remember, how do we interpret that? With a mean of, we would have to use the arithmetic mean that we don't even want to use, and then the standard deviation. And I decide, well, we don't think that this is very meaningful. It's not as meaningful as the geometric average return. So, I mean, we could take these together and talk about 2.5%, give or take 30. This is a very high volatility, right? But anyway, that's how you would calculate the variance of returns. So you can practice that too. So verify this too when you read the notes. Verify the calculation. So I did it here step by step with a table that you can also replicate. I did it again, the same thing, just calculated it several times. Okay? So this was the mean average, arithmetic mean. And this is the standard deviation. But this is not a sufficient period of time in order to see what we do see with stock returns. Over time, stock returns are known to be normally or assumed to be normally distributed. Here are some calculations. I've taken the data, I have the data from 1926 to 2008 and there, and then here I have till 2016. So this is my own calculations using the data in the chart that I presented you. And what do you see if I use US common stock? You see it's not perfect. Remember, we talked about smoothing out a histogram. It's not perfect, but it's approximately bell-shaped here. The important thing is, though, that the mean is not 0. The average is increasing. The average is positive. So even if you don't see it in this chart, over time, over this entire time period, on average, the returns went up. Yeah, they look like they're down, but on average, per year, over this 80-year period, they went up. And that's confirmed here. That's the mean. So although with 4 years of data over a very volatile time, I don't see, I shouldn't be using the arithmetic mean, over a large period of time, a long period of time, common stock returns exhibit approximately normal distribution. That's the mean, and then here's the calculation of the standard deviation. So this is over 1928 to 2016. What about this other period? It's similar, right? 11.7 is the average, and the standard deviation 20.6. It's very similar to these results. So over time, it's quite stable. So what I want you to do here is demonstrate using your memory of normal returns. If we assume returns are normal and we take the average that we calculated as the mu and we take the standard deviation that we calculated as the sigma, can you draw the normal density curve here? So let's get the numbers. Let's use the ones from, let's use the ones from the full data set, this one, 11.4. So let's take this information over there. So this is your information. I'll just cover this. Okay, so this is your mean. There's some other information in there, but for now, this is your mean, and this is your standard deviation. So plot here, assuming it's normal, It's 1928 to 2016. So I'm going to give you 5 minutes to try. I'm going to write that in a different color. So try and depict it and then answer the questions that I've posed here. Oops, oh my goodness. Oh. So try this. Did you do it? So what you have to do is you're going to make a curve. I wonder if I have a curve. No. So you're going to make a normal distribution curve that has a center of 11.4, and then within one standard deviation that's supposed to be one standard deviation. You have, I'm going to move this a little bit over. You're going to add and subtract the standard deviation here. So this tool helps you determine whether returns are positive and what chance returns are positive in the stock market. So should you invest? So I'm going to add to 11.4, I'm going to add 19.7, and I get 20.8. And then from 11.4, I'm going to subtract 20.8, and I get 11.4, subtract 20.8, and I get negative 9. Sorry, not 20.8, what am I saying? I'm going to 11.4 minus 19.7, and I get negative 8.3. So I went over by sigma, and now do I need to go again to answer the question? So the questions are, what is the chance of positive returns approximately? What would you say the answer is? So this is a common assumption that stock returns are normally distributed. So can you answer this question for me? What do you remember about the normal distribution? You're not allowed to forget anything I teach you. So what do you remember about the normal distribution? You remember that 68% of the observations are within one standard deviation of the mean. So that means this way or this way. So this is 68%. The negative, positive returns start around here somewhere, like over here. So we'd have to really approximate. You could figure this out using the standard normal table, but I don't need to be precise. I just want to get a rough idea. You know how to look at this. So positive would be all of this plus maybe 0 would be here. So we know from here over here is 50%, right? That's half. So that's 50% of the observations, or because it represents the population of returns, we say it's 50% chance. And then I have to add a little bit here for positive returns. Now this is not going to be precise, but if this whole thing is 68, then this is like 32. This is like 32%. Or 34, sorry. Do that again. The whole of this is 34%. So then, actually let's do that. I'll write that up there. So the entire range in there is about 34. So I'll just take half of it. I'll just say, what is half of that? So it's like 17. Do you guys remember this stuff? I don't know, you can say this is like approximately 17% and add it to 50 and say the chance of positive returns is like about 70%. So that can tell you, why people would invest in the stock market, right? Because it's about 70% returns. 70% chance of positive returns. I'm really estimating here. Okay, so that's my best answer. Do you have a different answer for that? I mean, these are kind of rough, right? This is like 0. I made it 0, but it's not even because this is 11 and that's 8. So it should be even more over this way. But I think you get the point. I'm sort of rounding things off. Let's allow me to make them add up. So I'll say 0 is over here, and I'll make this 20. I'll make this 20. Then it adds clearly. And this means just about or approximately. Okay, so what about the other one? What is the chance that returns will be less than negative 30? So you need to keep going with the adding in the subtracting the standard deviation. So what would this endpoint be in this one? So this will be another minus 0.197. So this one will be minus 28, right? Because you have to subtract another 19.7%. So that gives you negative 28. So this is good enough for about 30. So what is to the left of that? What's the chance of being here? Do you guys remember this stuff? So then if this is 68%, if this is 68% between, maybe, so it's 68 between here and here. What is it between here and here? This one was 68, and this one is 95. I made it go too far. I'm gonna cut it so it's not confusing. It goes to there. So if it's 95, then this must be 2.5 and 2.5%. So the chance that returns will be less than negative 30 is approximately 2.5%. So just some numbers I picked out. So the chance that returns are positive is 70%, and the chance that returns will be less than negative 30% is very small. It's 2.5%. So this is an application of the normal assumption to common stock returns, and it explains why people tend to invest in the stock market, because your chance of positive returns are likely. All right, so what else can I get from this information? Do you have any questions, first of all? If you need to remember that, go back and watch the videos from statistics that you have in the same, you have the same list of videos from MBA, UNDH. The videos are all there. So you can go back and have a look. Okay, no comments. So then what else do we have from this data? So what do we see? I'm going to look here, and then I'll look at the larger data set as well. So this is just a 2008, before the crash, or including the crash of 2008. You see that large company stock on average had a return of 11.7%, which is not as high as small company stock. So how do we explain that? Well, to incentivize investors to invest in smaller company stock, they need to be compensated. Their return should be higher to take on the additional risk. Look at the volatility of small company stocks on average, much higher than large company stocks. So this is just a way of dividing up the different assets. And you see here, if I smooth this out, it's not perfect, but it's an approximate, it would be a normal, well, we would say approximately normal distribution. Small company stocks, more spread out, right? That shows the volatility. It's much flatter. Less risky are bonds, because they have some commitment from the corporation. They have to pay you either face value of the bond at maturity, or they have to pay you, in addition, coupons or interest payments over time. And those are all laid out before you purchase the bond. So those are less risky, but still there's some volatility as they respond to market forces, right? These are the returns. This is the average return for long-term corporate debt. Government debt is about the same. Interesting, that's a little bit higher in volatility, but Treasury bills are the standard for less risky. The volatility is only 3.1%. measure of standard deviation, and the return on average exceeds inflation, and this is why investors choose to invest in T-bills. And then in order to invest in riskier class assets, taking on greater risk means that they would have to be compensated for a higher return, and if they weren't, these assets wouldn't exist. Okay, so what we're going to do here is talk about something known as the risk premium. This is a measure of the additional return that incentivize these assets to exist, or for investors to actually invest in them. So T-bills have a return of 3.8% on average. These are 3-month T-bills. So purchase them in March. By the end of June, you get the face value of the bond. I'm going to compare each of these to the T-bill and calculate what's known as the risk premium. This is often studied in finance. So the risk premium is a calculation of the return to the asset on average minus the risk-free rate. We're going to refer to this one as risk-free. And usually, because there's volatility, we will write it like that. So that captures that it's a mean, but it's the expected value because of the volatility. So compute the risk premium for each class of assets. So for the first one, it would be 11.7 minus 3.8. So the risk premium for a large company stock is 7.9%. All right, so keep going, keep calculating. So what's the value for a small company stock? What's the value for a small company stock? 16.4 minus 3.8. So this is the additional, this is the compensation. Oh, I put required by investors to invest in more risky small company stocks. Any questions? So as the volatility or level of risk goes up, as the standard deviation is higher, there's a greater risk premium for investors in that asset class. Okay. And then what I did in the next slide is I did this for all the years of data that I provided in the chart, and I calculated everything for you. So in terms of common stock, let's erase this one. Oops, that doesn't work. Nope. I can't get rid of it. Just get rid of it that way. All right, back to this. So you see U.S. common stock from the S&P 500. They plot like this. It looks approximately normally distributed with a mean of 11.4 and a standard deviation 19.7. This is what we drew in the curve together. Government bonds on average return 5.2%. with 7.8% standard deviation, much less risky because governments guarantee the returns. This is perceived as less risky and investors don't need to be compensated as much. T-bills are at 3.5%, so I can calculate the risk premium taking the average return for the asset class minus the T-bills. I do the same for government bonds. 5.2 minus 3.5 gives me 1.7. Any questions? So what we learned here is about returns, about calculating returns and how it relates to what we learned before. What we learned before about returns. About interest rate. And our goal is to estimate the risk-adjusted rate of return for assets so that we have the right R to use to evaluate projects or investments. This is where we're going. Okay, so that's the background material. So I've also prepared assignments for you. The review assignment that helps you review this is the one I showed initially. 26. So you can practice with document 26 to review that content. And here you see I ask you to create a normal distribution curve to answer questions about the probability or chance that returns of a portfolio next year will be between 8% and 25%. So you're going to repeat what we did when we created the normal density curve. And you answered questions about what's the probability of positive returns or negative returns. And then there's some questions using a list of returns. And then there's some practicing, you get to make calculations of arithmetic average, holding period returns, etc., and answer some questions. So these are all types of questions you can have. And then here's some more fun with nominal and real returns in when there is inflation. So you can practice with those as well. And then here I ask you to calculate for these returns. I want you to calculate probabilities. Now you need some more information to do this, I think, so that's what we're going to do next. You're going to calculate here for notice this is ex ante data because I give you the probabilities and states of the world and returns on three things: stock 1, stock 2, and the market return. So I have to teach you how an investor will perceive holding a portfolio of assets. So I'm going to begin with 2 assets at a time and how to calculate the expected return of the portfolio and the risk as measured by the standard deviation of returns. So that's what we're going to do next. That's what we're doing next. So this was document 26. All right, do you have document 28? Do I need to send it to you? Okay, comments. I'm going to begin here unless you have some questions. So it's a matter of practicing. You need to practice. Hopefully you'll have your assignments done soon and you can begin practicing, or you already had started practicing with the exercises I gave you on this material. So what we're headed to do now, you learned about the dividend growth model. So that was estimating the interest rate provided you make some assumptions, right? That's where I say you can calculate I equal to remember this was the dividend growth model. This is one way to find I, but I'm going to teach you another way to estimate the rates that you should use for valuation. The other method is called the capital asset pricing model. And to arrive there, we have to do a variety of things. Has anybody learned the capital asset pricing model before? So this material is very heavily layered with statistics, okay? There's lots of statistics that we're going to cover right now. So if you need any review there, I think I did what's reasonable, but you need to practice. I will be using Excel to demonstrate some of the calculations. But essentially, you need to recollect those formula and what we learn in statistics when it comes to correlation. Okay, so no one's learned capital asset pricing model before? All right, so I won't do too much because it's already 3:40. I'll do about 10 minutes, okay? And then we'll get going. Maybe not even 10 minutes. So let me just make the introduction. All right, so what did we learn? We learned that we need to take account of both the return of an asset and the risk associated with it. The return was the measure of the expected value or the average, geometric average, and the risk was the standard deviation of returns. And we have to keep in mind that investors like high returns, but often high returns are accompanied with higher risk. And we saw that when we calculated the risk premium. I demonstrated to you that higher risk assets have higher risk returns associated with them. So if you're chasing higher returns, unfortunately, it usually is accompanied by higher risk. But in general, investors like returns, but they dislike risk. So we're going to spend, in this unit, we're going to work with the ex-ante returns. That's where I give you a distribution of returns, and we understand that the results from that would be like population parameters, and the expected return would be the weighted average of the distribution of possible returns in the future. And the variance, or the standard deviation, is the square root of the variance, is a measure of the dispersion of the distribution of possible returns in the future. So let's not look at that right now. Let's focus on this. So this is the table. So we've seen this already. Believe me, we did this. So we have three states of the world. Either the gross national product of the economy will change by positive 1%. So that's not great. That's below average, right? Well, in the US. It will be about status quo. It'll increase by about 2% in a regular year. Obviously, last year was not an average year. But this is what historically we would look for, about 2% on average. And this would be a great year, 3% average, 3% change in the gross national product. The 2% change is more likely, it's 50% chance, and these are 25% each. And the returns look like this. So what you want to do now is calculate the expected return and the standard deviation of returns. So you could take this into Excel and do this. That would be the easiest way. So let's do that. So I'm going to put the probabilities here. And then the return here. So the probabilities are 0.25, 0.5, and 0.25. And the returns are negative 0.5, 0.015 and 0.035. Now you could use the whole numbers without the decimals. Oh, sorry, this would be 0.35. But I'm going to do it this way this time. So what I want to do is calculate the average. Remember, the average is the probability times the return, or x, right? But now we're working with the variable return. So the weighted average is a matter of multiplying, pre-multiplying each of these and then summing. And this is called the variance. Sorry, this is called the mean. I'm jumping. This is called the mean. That is not the variance, that is the mean. Okay, so you multiply them. And let me know if I made a mistake anywhere. Oh, this is the mistake here. Because there's not a 0 here. That's just 0.15. There. That makes more sense. Okay. Questions? So I'm going to carry this over, see if I can bring it with me, over here. So what I've calculated so far nope. There we go. So this is the mean. Let me do the standard deviation and then we'll go. Or should we do that when we get back? Okay, let's take a break and we'll get the standard deviation when we get back. If you want to, go ahead and calculate it or enjoy your break. Okay, so let's take a break and I'll see you guys back here at 5 o'clock. Okay, let's take a break. Okay, bye for now. I'll tell you again, but I just got word that your test will be at 12 p.m. on May 16. It will just be 20% of your final grade. It'll be the last test or last assignment. It will be in the classroom. You will be divided into 3 separate rooms. so as to distribute you. Oh, and we can talk about when you get back on what you can bring to the test. And I'm going to say anything, but I recommend just put formulas on a formula sheet and just have some exercises with you printed out. I guess you're going to have to be able to use your calculator or your computers. So, have to talk to Dorant about that. We're going to have to make a test that you don't need your computer, just your calculator. Okay, enjoy your break.